Welcome back, everybody. This is our latest edition of Weekly State of the Market, brought to you by Finom Group and me, Seth Golden. Kind of just wanted to give a shout out to everybody, let you know I'm feeling a lot better. I'm still trying to get over this cold/flu. No, it's not Corona. I had my shot, but when you have toddlers in the house, you're bound to get what they have. And my son's had a cold. I caught it, lost my voice for a good 4 or 5 days, wasn't able to do a recording of last week's State of the Market. So just wanted to kind of say, here I am. I'm doing better. I'm feeling better. Still have a little hoarseness in my throat. May still have to, take some pauses here during today's recording. But that's also why I'm saying hello. I still get very hot if I get worked up. So kind of no sleeves day for me here in the office. But again, welcome back. Let's get straight to it because we got a lot to cover here this week, and hopefully we can get through it in the 45-minute time frame. We've had all these shifts in the market over the last 9 months, and even more so in the last 30 days. It's a really unique environment that we found ourselves in over the last year, right? COVID, bear market, bull market, recession, new expansion cycle. Just a different participation in the market. It's just been a lot to absorb for tried and true investors that obviously none of us have really been tested in this kind of environment, but nothing's permanent in the market. It's something we have to, kind of remind ourselves of. There's no permanency here in the market. We're already seeing a bit of an adjustment, in the first quarter of 2021, where we're losing some of that retail participation that was so prolific during the pandemic shutdown, and when the stimulus checks would go out and what have you, funding of Robinhood accounts and all these different new traders in the market. But we're seeing that start to dissipate. We're seeing the SPAC trade unwind. We're seeing a lot of the froth in the market not only unwind, but the money's still there. It's just a matter of it flowing to different areas in the market, something that we've been highlighting for probably the last 2 months. And since I would say the Nasdaq went into its correction mode, we've been covering the Nasdaq correction, following the technicals, the different industry groups in Nasdaq, highlighting tech, highlighting growth. And I think the overall takeaway from the last couple months, if not the first quarter of the year, is you gotta follow the flows. You have to be in tune with where the money is leaning, because where it's leaning, it'll eventually flow toward. Now, with that being said, we came into this year with tech under pressure, growth under pressure, the whole value versus growth trade where value took leadership and is still leading here in the new year. But over the last 30 days, we've seen a lot of weakness in value. Not just value, but small caps, mid caps, which has also been kind of trumping large caps. Fan mag, it's been small caps, mid caps, equal weight, and value. That was the trade during the first quarter. But at the tail end of the first quarter, maybe the middle of March through today, we've seen some of that unwind. So I want to stress that there's no permanency in the market. The market ebbs and flows. The market is a constantly evolving structure. The participation in the market that we saw last year, the speculation that we saw last year, is probably not going to be rewarded to the same degree here in 2021. And maybe that's also why we're starting to see some of that retail participation unwind. Don't miss this point, folks. Rewind it. Play the tape again, as they say. Go to the instant replay. Don't miss this. The same speculative behavior that we saw last year is not going to be rewarded the same way this year. And we're seeing that it isn't already. One of the things we're going to see also is a lot of that retail participation just eliminated. People are going to trade themselves out of the market. You may have heard me say this in the past. New York University study dating all the way back to 1990. They looked at market participation going all the way back to 1990. 90% of traders they found will trade themselves out of the market within 2 years. I happened upon this this brief interview or interface between, well, that's not going to work for me, between Jeff Bezos and Warren Buffett years back. And what it shows you here is right here, they were in a meeting and Jeff Bezos asks Warren Buffett, well, he basically says to Warren Buffett first, your investment thesis is so simple. You're one of the richest guys in the world, and it's so simple. He basically just buys good companies and holds them for almost ever. He also likes dividend stocks. So Jeff Bezos says, why doesn't everyone just copy you? And as simple as it sounds, this is what Warren Buffett replied with, because nobody wants to get rich slowly. And that's what I mean. That's why I think we're going to see that much less retail participation and overall market participation in 2021 going forward, because most people don't develop the disciplines they need to be a long-term successful trader / investor. People want to get rich quick. They don't develop the resources. They don't develop good disciplines. That's the speculation we saw last year that is likely not going to be rewarded the same way. And so people will give up. They'll get out of the market. And of course, you're going to hear the market screwed me. It's rigged. It's manipulated. No, you just didn't do your homework. You didn't dedicate yourself to resourcing yourself, study, developing good disciplines. And here's kind of the curve that you see people go through in their trading cycle, especially newbies when they get into it, because nobody wants to get rich slowly. Again, remember that was Warren Buffett's response, and it tends to be true. Here's kind of the learning curve that we see new investors go through. I know everything, right? Because it's working. A lot of people, it didn't matter what you threw money at last year. It worked. So people think they know everything. There's a lot of luck involved coming out of a bear market. Everything tends to snap back rather fiercely, strongly, and without any material correction thereafter. So they know everything. And then there's more to this than I thought, right? Because things tend to slow down. You're starting to realize it was a little bit more luck that I was using than it was skill. And then it gets worse. I'm never going to understand this. Now, if you stick with it, course correct, start to understand where you're going wrong in your trading regimen, investing regimen, it can start to make more sense. And then you start to swing up on the curve again. But you also realize it is complicated. But if you stick with it, you tend to do well. Again, one of the reasons why we find 90% of traders trading themselves out of the market within 2 years, bad discipline, no resources, because they're taking too much risk and they're engaging in a lot of speculation because nobody wants to get rich slowly. Have faith. Stay the course. Stay in the market, folks. You're not going to make anything on that cash or in your savings account. All right, so we talked about, or we highlighted that, tech, Nasdaq, this is growth, large caps, Fan Mag. That's been out of favor for much of 2021. And we've seen a lot of outflows recently when it comes to tech. Keep in mind, though, when you see the outflows, that tends to be when that area of the market starts to perform better. When you see the heavy inflows, because keep in mind, this was the exact opposite. It was the exact opposite after the March monthly options expiration. We saw the strongest inflows into QQQ that we've seen since 2009. And, well, here we are. So the theme of 2021 has been value versus growth, cyclicals over tech. Although there has been a slight increase in put buying over the past 2 weeks. And last week, we saw the largest tech outflow since September of 2020. Last week, we also saw 2 positive developments in the Nasdaq. On Wednesday, last week, the index triggered a follow-through day. A follow-through day, or FTD, is a big up day that occurs on higher volume than the previous day. It doesn't guarantee that a market has bottomed or an index has bottomed, but no market bottom has occurred without a higher volume day. Rather than get too technical about this, think of it as a bullish sign that big institutions are coming back into the market. The second positive development is that the index got back above its 50-day moving average. On Thursday, that was the follow-through day. On Thursday, April 1st, the index got back above its 50-day moving average, which was its third bout above the 50-day moving average. Something that I often say is the more times that you brush up against a key level, or same thing on the downside, the more times that you brush up against support, eventually you break through, whether it is to the upside or from a support standpoint to the downside. And this time, the third time above the 50-day moving average, it broke out to the upside. So some positive developments last week that have found follow through here this week. Again, tech has been underperforming, and this started, just around monthly options expiration last month of March. So if we look at the tech sector ETF, relative performance to the SPDR or the S&P 500 as a whole, we can see that it held support. This long trend line here held. That's a good thing. It teaches us, or it informs us, that this was just consolidation, a normal correction, if you will, within a cyclical bull market. Money just was rotating someplace else. Look at how long this has been in an outperforming trend. Remember, this is the relative performance of XLK tech sector versus the S&P 500 or the SPDR ETF. Tech has been stronger than the SPDRs for all this time. And it's just going through, if you will, a pause, consolidation. But it held this support. That is bullish. Now the sector looks like it wants to break out at this point. The only thing really left is making new relative highs. One of the other things we've been talking about is, well, if tech's going to work, we need some of the sub-industries within tech to work. We need semiconductors. We need software. We need cloud computing. We need cybersecurity. We need these sectors to work. Those are the industries within the tech sector. We need those to work as well. Last week, same thing as the Nasdaq. And by the way, if you put up the SMH, which is the Semiconductor ETF, if you put this chart, you do a layover with the Nasdaq, it's identical. They have the same consolidation formation. So just as the Nasdaq closed above its 50-day moving average last week, so did the semiconductors. And what do we have here? Follow through this week. In fact, the only thing that's left in between, so far as upside resistance, if you will, is a new all-time high in the SMH. It narrowly missed it yesterday, by the way. Got up to 257 and change before it pulled back, fell into negative territory. Here it is today, up 277 at 255.81. Semis are working. There's a lot of bullish commentary out there from the analyst community because of all the shortages, the chip shortage. They're going to have much better margins. There's a lot of demand. There's too little supply right now. Some notes here from UBS. Our Finom Group members, you're going to get the first crack at this as always. You get the first, read into the state of the market. You get to go on site, log in, and check out all these notes for the state of the market video. If you're not a member to phenomgroup.com, strongly urge you, visit phenomgroup.com, subscribe so you have the same access. More notes, semiconductors, game on. Steam tracker plus pricing survey by NVIDIA, by AMD, Goldman Sachs. Philadelphia Semiconductor Index. Now, we talked about last week, but it carried over into this week. Monday's gain for the SOX adds to a 9.5% gain for the index last week. As shown in the chart above, that 9.5% rally is historically large. You see where it gets to this line. This was back in, the heydays, if you will, kind of the dot-com era here. We had the same thing coming out of the 2008, 2009 bear market. About with it here, and of course coming out of the bear market in 2020. But again, we're hitting this threshold. The 5-day gain through Thursday's close stands in the top 5% of all 5-day runs for the index, talking about last week. While there was another occurrence as recently as the 5 days ending March 15th, that's right here, moves of this size in the semiconductors have been fairly uncommon in the past decade. Prior to the most recent and March occurrences, the only other recent instances were in November and the spring of last year. Prior to 2020, the past decade only saw a small handful of other instances of rallies in the 95th percentile. That's what this basically is. You're in the 95th percentile of rate of change over a 5-day period. Conversely, the volatility of the financial crisis and the late 1990s and early 2000s led to more frequent clusters, top 5% moves, 1990s and 2000s, right in here. So what happens next, right? When you get that kind of 95th percentile rate of change in the semiconductors, the SOX, if you will, well, typically you get kind of a pause, and that's what this basically shows you. 1 week later, down a little bit. 2 weeks later, down a little bit more. Gets better the further you go out in time, 3 months and 1 month. Here's your positivity rate here. Positivity rate for that particular time frames up here. But that's not what happened 1 week later, right? We are 1 week out from that rate of change we were just talking about. We're up nicely this week in the SMH or the SOXX, if you will. Why? Why are we defying this historic data here? I'm of the opinion breadth is just that strong. This chart right here from Macro Chart shows you the 1 week change percentage, extreme strength relative to the price thrust, initiating that rally. The breadth is just so strong right now in semiconductors. The reason price has continued higher despite the historic data from Bespoke Investment Group is likely because of the extreme breadth in semis. Macro Ops, also a very well-known Twitter account, he made a prediction. Alex is his name, made a prediction. The super cycle in computing power is going to become a mainstream narrative in the coming months. That's his prediction. Quite frankly, I'm in alignment with it. Now, some of you Finom Group members, you've seen this study before, right? When semiconductors on a year-to-date through mid-October rise between 25 and 50%, the momentum tends to continue. So this is last year. We were up 31%, 31.84% through mid-October of 2020. just like all these other occasions here. It's a reasonable sample size, 1, 2, 3, 4, 5, 6, 7. That's good enough. Look at the forward-looking returns, folks. We're what, October, so let's say November's 1 month. December, January, February, March. Here we are in April, 6 months later. 97% of the time, 6 months later, semis are positive. The average return is 35.5%. 97% of the time, semis are still higher. And guess what? They are still higher. If we look at SMH here, see if we go to October. Yeah, we're a lot higher, folks. Here's mid-October right there. Are we higher? Absolutely. What was the price then? Closed at 189.94. We'll call it 190. It's at 253 now. 255, sorry, 255. You do the math. This is why the data is that valuable, folks. But forget, we're through 6 months, right? 1 year later, semis up on average, 43%. The positivity rate, 88%. What does this mean? How is this actionable? Well, quite frankly, right here. That's how it's actionable. Buy the dip. The data tells you what to do when semis get weak. Buy them. That's it. Buy the dip, folks. The data is your guide. True, history is not always going to repeat, but the more often you align with the statistical data, the better you will perform. All right, so we got semis working, which is awesome, but that's just one industry within the technology sector, right? We need software also. I said that earlier. We need software. Well, software didn't quite finish. It actually finished right at the 50-day moving average just yesterday. And today, this is a chart. You can see it finished right at the 50-day moving average there. Today, folks, let's see. IGV is the ticker symbol. You want to see an explosion? There's your explosion. $6 higher or 1.73%. It had actually been more than $7 higher intraday. Take it to the big boy chart here. And there you go. Above the 50-day moving average nicely. Really, the only thing that's left is we'd like to get above this neckline of the head and shoulders pattern, if you will, or the W, depends on how you look at it, right? It does look like a W. And by the way, we talked about how the semis look just like the Nasdaq chart, the correction and whatnot. So does IGV, the software sector ETF. They all look the same. Nasdaq finished above the 50-day moving average. Semis above the 50-day moving average. Just a step behind, now you have software. These are the components. This is what you want to see. And here's the Nasdaq. So, throughout the correction, is it going to be bigger than this? Is Nasdaq going to lag the whole year? Look at interest rates. Look at how, the 10-year rises and the Nasdaq does poorly. Tech does poorly. Tech is a duration asset. So how could it do well with the Nasdaq rise, with the yields rising? Well, it has. It's come out of the correction. Yields are only slightly off of their highs. And so is the Nasdaq at this point. But true to form, when we look at our trend line, this is a 1-year trend line of the Nasdaq. It held perfectly. Perfectly. Nasdaq above the 50-day moving average. And really, same thing with the Nasdaq, folks. The only thing that's really left there is going to be getting to all-time highs. That's all that's really left. Do you think it can do it? It's going to do it. It's just a matter of when. Here we were. We're not far from there now. A couple more days like this, Easily accomplished. Money rotating back into tech, back into the Nasdaq, back into large cap growth. People don't want to be out of the market, but they want to be in line with where the cycle is. We were early cycle, reopening cycle. So people were buying small caps, mid caps, cyclicals, value. But now we might be edging closer to the mid cycle and things have sped up, this go around. So you see another rotation happening. It's going to be a stock picker's year from this point on, or a sector picker's year. You got to think about diversification going forward. And you want to be in tune. You want to have your touch points with the market so that you can see and know where your capital needs to move from one quarter to the next. Here's another one. Fang. This is the equal weight Fang index, folks. Just broke out to all-time highs this week. Facebook recently hit a new all-time high this week. Google, new all-time high this week. Amazon is up 10% in the last 2 weeks. Apple up 8% in the last 7 trading days. Microsoft, new all-time highs this week. Opportunities. Was anything wrong with the fundamentals of these companies based on their last earnings report from the Q4 period? No, most of them beat manageably on the bottom and the top line. Some of them easily. Opportunity. See, one of the things that we talked about recently in the Finom Group trading room was, again, there's been a lot of speculation, a lot of people chasing value, chasing small caps, because that's what was working. I'm not terribly comfortable doing that. Why? Because that's not where the earnings are. That's not where the growth is. At some point, that trade loses its luster. And the money starts to rotate back into tried and true tech, large cap growth. What's the easier thing to do from a discipline standpoint based on years of experience? Buy the weakness in tech, buy the weakness in large cap growth. It's easier. You don't have to worry about, am I getting out at the right time for small caps and mid caps and value? You don't have to worry about that. Really, the only thing you have to worry about is, do I have enough cash on the sidelines to buy large cap tech, semis, and growth? That's it. That's an easier way to participate. The speculators who didn't see this rotation happening, they're the ones that are hurting right now. Do I think this rotation is going to find tech and large cap growth infinitely leading? Not really. I think there will still be, an opportunity there for small caps, mid caps, value to come back again. Problem is, a lot of people are going to give up right now because they've been hurt by those areas of the market. They're not familiar with rotations. They're not familiar with cycles and trends and styles. Those are the people that need resources. Those are the investors that need to stick with it and gain the experience. Enough said, off my soapbox. Anyways, Nasdaq, here's kind of a seasonal chart for every day within the calendar month of April. The highlighted areas in green, which is just about the whole thing, shows you that the Nasdaq has a better than 50% chance on almost every single day in the month of April to be positive, to produce a positive return. This is the only one that is like 50-50, if you will. Just thought that was interesting. But all this while, and I get it. I get why people avoided buying the dip in Nasdaq, buying the dip in the Qs, buying the dips in the fan mag stocks, Facebook, Apple, Microsoft, Netflix, Nvidia, Google, Amazon. I get it, right? Because, well, they were lagging, A. And what do you hear on CNBC day after day after day after day? They're not going to come back. Look at rates if they continue to rise. Guy Adami on CNBC, fast money, almost nightly. I don't think that these fan mag names will come back. I think that the 10-year yield is going to continue to rise to 2% and put pressure on these names. How'd that work out? Again, I get it, but their guess is just as good as yours. They don't know any better what's going to happen tomorrow than you or I. What we have is a basic fundamental understanding of these companies, what they just reported from their Q4 business cycle. Nothing was wrong with the fan mag names fundamentals. If nothing changes in the fundamentals and the only changes are to the share price, that's opportunity. No matter what these people on CNBC, Bloomberg, or any of the financial news networks are saying, it's opportunity. Take stick-with-itness and experience. And a lot of folks are seeing what happened. We had analysts come on all the time on CNBC. Mike Wilson of Morgan Stanley, their chief equity strategist. These are his notes that we disseminated to the phenomgroup.com members back on March 6th, right here, March 6th. We disseminated these notes from Mike Wilson's report saying that he basically believes there's going to be another 8% downside in the Nasdaq, which would take it to 11,618. Yeah, that didn't happen. Could it still happen? Yeah, I mean, anything can happen still. Until the Nasdaq actually makes a new all-time high, technically this is still in play. But imagine, again, you avoided this because of the talking heads. It's a chief equity strategist at Morgan Stanley. He doesn't know any better than you or I. Nobody can predict the future. Everybody's given their best guesstimate based on their experience, their touch points with the market, what their data suggests. He was leaning the wrong way. He's still leaning the wrong way. Invest in good companies with good fundamentals. You'll be fine over time. And by the way, we haven't even talked about the dividend. If you had bought Apple, right? Microsoft, you get paid to wait. All right, something else that we talked about a little while back. This was actually in our March 9th report. You see this chart here of the Nasdaq 100. See that volume spike? Again, this is revisiting our March 9th State of the Market video. And what it basically shows you is that when you get a volume spike like this, it's usually marking a bottom of a move. It happened on a significant update in the S&P 500. Nasdaq basically bottomed, and the next day we had a 3.6 or 3.7% rebound in the Nasdaq on tremendous volume. So here's a study from Quantifiable Edges that tells you after that kind of move, that kind of volume, if you will, that kind of volume, 21 days later, which is basically a month, the Nasdaq or the Qs are up on average 1.38%. 42 days later or 2 months later, on average, 5.54%. Are the Qs up from March 9th? Absolutely. Is the Nasdaq up from March 9th? Absolutely. We'll see what happens 2 months later, 3 months later, 6 months later, a year later. Look at, do you see any red here? You had this one red that was, coming out of, well, that was going into, I should say, the bear market last year. There's no failures here, folks. 100% positivity rate, basically, after you get this kind of a volume upswing there in the Qs, in the Nasdaq. Keep these studies handy. All right, well, this chart right here says it all. What do you think this chart means? Well, it's basically heralding, of course, doomsday, because, of course, this was the market cap as a percent of sales for the S&P 500 during .com, and we've exceeded that by leaps and bounds here in 2021. These are notes from, of course, Citigroup's chief market strategist himself, Tobias Lefkovich. Let me give you a little background quickly on Tobias. He's always He always has a subdued outlook on the market. Always. He always underprices his target for the S&P 500 on an annual basis. What does he do as if it's his religion? Fourth quarter comes around, because of course the market is already well above his annual price target. He raises his price target. Every year he does that. I take his notes with a grain of salt, but in these notes recently, he's talking about bubble territory. Price to sales is well above the peaks of late 1990, early 2000, making Citi uncomfortable, while its panic euphoria model is also cause for concern. Sentiment is in very worrisome territory, as is valuation, yet money flows continue to push indices higher. Huge fiscal stimulus and support of central banks have created the notion of there being no need to be risk averse. I disagree with that. I think there's plenty of risk aversion. Otherwise, Tesla would be what, $900 by now. But it's also going through its correction. The market is actually behaving quite typical coming out of a bear market and recession. It's rotation after rotation after rotation. Small caps led out of the bear market, just as they do most bear markets and recessions. Financials took over, just as they do most bear markets and recessions. Tech has lagged. Yields are rising, basically pricing in an economic recovery. This is normal and to be expected. You don't like the valuation of the S&P 500? Too bad. In 2017, the S&P 500 forward-looking multiple was 19 times. In 2019, it got up to 20. It's 21 and a half times now. It was at its peak 23 and a half times. It's come down 2 percentage points, or 2 multiples, if you will. My point is, from 2017 to today, we've actually seen the high teens and 20 forward-looking multiples. Multiples expand over time. You don't know when it's going to happen or when it's going to end, any more than you know when multiples are going to contract materially. But they tend to work in super cycles. Using valuation as a guide for suggesting you know true value or capital allocations is a terrible discipline. Again, you could have said that throughout this entire post-pandemic rally and missed out on an 80% rally in the S&P 500, almost 80%. You could have said that along the entirety of the way. Valuation should not be your guide, people. And the market is not valued to sales, by the way. It's valued to earnings. When I see these charts, I kind of chuckle. I'm like, I'm sorry, that's not how the market's valued, any more than it's valued to GDP, right? The Warren Buffett indicator, you heard about that. Market cap as a percentage of GDP. Even Warren Buffett himself, or Charlie Munger in an interview on Bloomberg said, just because Warren Buffett said something about how he values markets 30 years ago doesn't mean it applies today. Markets evolve. Participation evolves. Yeah, another one of fan favorite. Here's another, identifying a bubble. Of course, Ray Dalio. Talk about your underperformers of underperformers. The Bridgewater Fund had to actually bring on a new chief investment officer last year. But we're supposed to take advice from Ray Dalio. Nonetheless, I put it here. It deserves its airtime. It's something to consider. You want to know what both sides of the ledger have to say about the market, so to speak. You want to know what the bulls are saying, what the bears are saying. You want the information. You don't want to be scared. The more information you have over time, you'll be able to discern based on that information and how it correlates to the market, how to basically filter the information over time. Again, the rotations are good. That's normal in a bull market coming out of a recession. coming out of a bear market. But you also want to know that breadth is supportive, validating the bullish move. And it is. That's the other part of this whole equation. It's one thing if it's just a handful of stocks that are pushing the index higher because the indexes are cap weighted. It's a whole other ball of wax when industry breadth is as strong as it's showing here in this chart from the sentiment trader. Among industry sectors and global indexes, we are now seeing amongst the best participation on record. This is judged by 4 positive metrics, like the percentage of indexes above their 200-day average, and 3 negative ones, like the percentage of indexes at 52-week lows. Very few are at 52-week lows. The majority of industries are at above their 200-day moving average. It's incredible the amount of participation, the strength and the breadth in the market for the last, I would say, 6 months. It's validating the move. That's what you want to see. You want to look under the hood and make sure this isn't just, fumes, if you will. S&P 500 industry group uptrend, this is just uptrending, is at 88%. You go through these, peaks and valleys here. We're at 88% of industry groups are in an uptrend within the S&P 500, folks. This is so much like the dot-com era, right? According to Tobias Lefkovich of Citigroup. This is so much like the dot-com era, except it's nothing like the dot-com era. The blue line is the Nasdaq. The yellow lines are the S&P 500. Look at the gap here between the Nasdaq and the S&P 500 on both of these just incredible moves. Look at it today. The S&P 500 is participating with the Nasdaq. That is not what you saw during the dot-com era. Not to this degree, folks. Again, breadth, participation. This is a very different picture than what we saw during the dot-com era. Don't let anybody fool you. Do your research. Talked about, again, rotations in the market. These 3 charts here, if you will, or panels. This is basically from the top to the bottom. You have the mid caps at the top versus the S&P 500. In the middle, you have the small caps versus the S&P 500. And at the bottom, you have micro caps versus the S&P 500. What do they all have in common? Well, they were all outperforming the S&P 500, quote unquote, large caps, during this move here. And basically since early March, mid-March, they've been underperforming the large cap S&P 500. This is mid caps, small caps, micro caps. I don't think this is going to continue forever. Right now, the large caps are catching up, trying to get to basically a market perform on the year compared to small, mid, and micro caps. But this is the weakness. This is the rotation back into large caps over the last 30 days, if you will. How do we know they're going into large caps? How do we know that they're going from value to growth? This is another chart that basically validates what's happening. This is the S&P 500 Citigroup Pure Growth Index. Now, when we looked at this, when did we last look at? This was right here. You can see right to the 50-day moving average. This was from our State of the Market on April 1st, just last week, right at the 50-day moving average. Today, nicely above it. Some nice candlesticks. Yesterday, a bit of a pause here. Look at the MACD, folks. It doesn't get any prettier than that. Look at RSI. Look at this, right? You bottomed out, bottomed out, bottomed out. Now nicely above the 50-day moving average. And realistically, the only thing that's left is right over here. And again, same pattern as the semis, as the Qs, as the Nasdaq, this same pattern here, this W or kind of, if you tilt your screen, inverse head and shoulders, right? But we'll call it a W for argument's sake. All that's really left is going to be coming out here. When will it get there? Don't know. It will get there, though. This is a new expansion cycle, a new cyclical bull market within a long-term secular bull market. S&P 500, pure growth index. What is the Nasdaq? It's pure growth. Nasdaq doesn't have exposure to financials, energy, or materials. It's large cap healthcare. It's large cap tech, information technology. It is pure growth. And that's why the Nasdaq is performing now. That's why it's getting its mojo back. How high can the S&P 500 go, right? Almost 4,100 today, Thursday, April 8th. I think the high here today, 4,096 the last time I checked. How high can it go? Maybe it is just here at 4,136, which is the 618 Fibonacci extension level to the upside. Maybe that's it. We don't know. The charts tell us what has happened and what is developing. We don't predict the future. What does it matter? Get to 400, pull back 5, 6, 7, 8%. Maybe we do have a 10% garden variety correction. Buy the dip. As long as your indicators, and the indicators that I use are credit spreads blowing out. No? Okay, buy the dip. Is the yield curve inverted? No? Okay, buy the dip. Are earnings trending higher? Yes, buy the dip. Are we in a recession? No, buy the dip. Buy the dip. As long as your indicators tell you to do so, you shouldn't be panicking if we fall 5, 10% from these highs. In fact, the second year of a bull market, after a 30% bear market, the average maximum drawdown in that second year is 10%. Normal, to be expected. Not to be panicked for, not to be feared for. Have a game plan and execute. Again, as long as those buy the dip indicators are working, do so. Engage your game plan and execute. Average monthly return of the S&P 500 index since 1996, all months, April is one of the best. Love it. Love it. 9 out of the last 10 Aprils, the market has been up. 9 out of the last 10 years in April, the market has been up. It's been in the past 20 years, it's been the best month. The past 10 years, it's been the second best month. In a post-election year, it ranks the 4th out of 12 months. This is typically the pattern that you see. Seasonal data, I don't fancy too much. You tend to want to pair it with other data. The seasonal data can be wonky. To me, it's less reliable. I'm just giving you the information. Why do I say that? Well, add this up here for the first quarter, folks. January, in the first year of a presidential cycle, which is what 2021 is, it's the first year of a new presidential cycle. January is supposed to be good. We were down in January. February was supposed to be bad. We actually were slightly positive by like 1/3%. March, supposed to be good, and it was. But if you add these three columns up and you take into consideration this 1.66% average decline in the month of February, the quarter's supposed to be down in the first year of a new presidential cycle. Yet, we were up about 7%. That's why I say the seasonal data you kind of want to pair with other data. I'm just giving you the information here, folks. Now, having said that, the S&P 500 was up 1% in the first 2 trading days of the quarter. Excuse me. While it had 2 back-to-back gains of 1%, came 4 calendar days apart, though. this is the first time that the S&P 500 has kicked off a new quarter with back-to-back 1% gains, right? Because we had the holiday and the weekend since 2009. In the post-World War II period, there have only been 7 other quarters that kicked off with back-to-back gains of at least 1%. Here's your years that it happened. Now, prior to 87, the rest of the quarter was red. But since 1987, they're all green with a substantial average return, even when you consider this. 3.9% the rest of the month when you kick off the quarter with back-to-back 1% gains. Good sample size. Again, the data is there for probabilities. They're not there for guarantees. We have monthly options expiration next month. Again, this is why we want the information, we want the data, but it doesn't always play out. March is typically one of the best when it comes to monthly options expirations weeks. Here's the month of March. The good ones are highlighted in yellow for the particular months and the week of monthly options expiration based on a percent positivity rate. 76% for December, 75% for October, March 67% positivity rate, and April 67% positivity rate. But we were down in March on this particular week. Supposed to be the same percent positivity rate for monthly options expiration week in April. So we'll see if this time it actually works out, because it didn't for the month of March. You lean into the probabilities, but again, they're not guarantees. It's good data to have handy nonetheless. And kind of thinking about next week, because it's all about gamma at this point when it comes to monthly options expiration. I think the greatest gamma exposure is down there at the 4,000 level. So just keep it in mind, no guarantees. Gamma's not everything, despite what the Twitter sphere will try and tell you. All right, so there's just one more I want to get to, before we cut this out for the day and close up our weekly state of the market. Again, thank you for joining us each and every week here. But this also is I've been looking at, and I'll show you here, because while most of the breadth indicators have been strong, the NYSE hasn't. NYSI, that one hasn't quite picked up to the degree that I'd like to see it pick up, and it has a series of higher lows. It has picked up lately, as you can see here. In fact, even with the Nasdaq down yesterday, and the NYSE kind of iffy in terms of breadth, because this is an advanced decline ratio, we still saw it climb. It was recently below 500, and now it's at almost 600. In terms of what does this mean? Well, that's kind of what I want everybody to explore here with us. This is from Tom Mcclellan. His family created the Mcclellan Oscillator. And what we see here is, this smooth area, and then we see these bumpy areas, right? A smooth move in the summation index, the NYSE summation index, the Mcclellan Oscillator. Oops, sorry, wrong screen. This right here. Mcclellan summation index. A smooth move in the summation index is one that is nearly linear, kind of like what we see here, right? What we see here. It conveys a message about strength for the direction of the move. So in the case of this week's chart, we see smooth, sustained up moves here, up here. We also see some bumpy down moves, right? This is bumpy, this right here, and this is bumpy, this right here. Bumpiness is an indication of weakness for the direction of the movement. And so a bumpy down move like this and like this says that the bears are not very organized. The bears might still be trying hard, but they are not in charge. So the combined message at the moment of a smooth up and bumpy down pattern says that the bulls are in charge and the bearish side is relatively weak. That's a positive message for the stock market, folks, when you're analyzing the summation index. This is another indicator that suggests these bumpy moves here should be bought. Because the bears, it's a tough slog for them. Everybody's buying the dip. The bearish down moves are shallow and short in duration. So I thought this was just another good tool. Again, if you go to stockcharts.com, type in NYSE, and you'll be able to study this. What I'd like to see, obviously, is getting above this, moving average, and then getting above. Stop with the lower highs. That's when I want to see stop. Kind of like what the Nasdaq is doing, kind of like what the tech sector and tech industries are doing now. I want to see this one stop making lower highs. And with that, that's a wrap, folks. Thank you again, as always, for joining us here on the weekly State of the Market. We'll see you next week, Thursday. Everybody trade safely.